Good morning, I'm Catherine Ross, and I'm joined by Jim Cramer. We're joining you via Skype this morning in our efforts to do our part of social distancing. Jim, what's top of mind for you this morning?
Well, top of mind for this morning is this remarkable rally and all the things that were left for dead. Retail, airlines, travel, and leisure. I mean, these stocks are up as if, this is really important, Catherine, as if happy days are here again and that the stocks went down too much. Now, I am a believer that some of these stocks went down too much in the sense that even if business is terrible, these stocks don't go down that fast. I mean, it bleeds over time. But I have a piece in Real Money this morning that talks about how capital is more available than it was. Um, but I also want to preface that, while capital is more available than it was, that does not necessarily mean you want to own stocks. But I am, as we talk, making some moves because I do feel that there are situations that are up too much and that the club members need to know that we are on the case right now, writing stuff up that is not being deterred by doing our videos, particularly the free video, because I very much want to make some moves here now that the market is, I think, set up to go back down. Not necessarily today. When you open up big and then you go down a little, if we catch a bid down, say, catch a bid right around here, we will finish up for the day. That's not my point. We are at 12.5% cash, and I want to be up to 15% cash after putting so much money to work when we were going down. You need to be able to be ready for the next downturn and have that cash.
And we'll be covering all of your moves live over on Action Alerts Plus, our daily rundown show, right after this. Jim,
Yeah, Catherine, it's funny. When you ask me top of mind, what I say is, well, let me tell you what I've been telling top of mind. Top of mind is we got some stocks that we didn't buy right, and I want to be able to sell some stuff if it's necessary.
Jim, let's talk about your Real Money this column this morning. I want to focus specifically on the differences between this pandemic and 2008. Now, we've laid that out before. And obviously, there's one big one, which is health versus an economic collapse caused by human nature. I want to focus, though, on what bigwigs are doing differently than they've done before this time around.
The bigwig, what, the hedge funds? Or the
hedge funds, executives, anyone in a position of power, what are they doing differently than now as opposed to 2008?
It really helped that they went through that fire drill. Now, at the time, wasn't a fire drill, but it really helped because what happened is that let's say they were raising money. Well, what they did was decide to raise money on the long term, not the short term, so that they were not going to be faced with some sort of credit crunch right up front. They spaced out their maturities really well. I also think that they decided, you know what, let's keep some money on hand. Let's keep our inventories low. Let's not be beholden to any particular banker. Let's get credit lines so that if things get bad, we're ready. And, what's happened is that some companies that we thought were in more trouble aren't. And that's very, very positive. And it's making it so that people feel more confident about buying stocks. The question is, are they too confident? And I'm beginning to think they are.
What about the companies that are positioned well? What if the companies that you mentioned in your Real Money column with a lot of cash on hand, such as the FANG stocks? If I'm an investor, should I be padding my portfolio more with those kinds of stocks of companies that have cash to spare?
I think absolutely. We have not sold any of those with cash to spare. Why we haven't sold those cash to spare? Because they're going to be not just winners, they're going to be rulers. Now, the issue with FANG is the government. Like Facebook can't buy anybody, Amazon can't buy anybody, Netflix maybe, but Alphabet can't buy anybody, Apple can't buy anybody without real scrutiny, antitrust scrutiny. So it's not worth wasting their time, Captain. But boy, the balance sheets they have are so great that you start thinking, wow, maybe other companies going to go under and they're going to own it. This is the one that I posit right now, Home Depot and Lowe's. If you own Home Depot, which we did, and I feel somewhat bereft that we didn't stay long. It was such a good stock. Two that I regret that we sold were Home Depot and Cisco, but we wanted to raise some capital for others, which were in many ways better. But Home Depot has a lot of True Values that competes against still a lot of mom and pop hardware stores, and they're not going to make it. You could say, and Lowe's is going to make it too. So those two are going to have a duopoly on hardware, and who knows what they can charge. Now, I think they're both geared toward giving the consumer the best value, particularly the and definitely the contractor. But Catherine, I mean, you're going to have two stores dominate 100. I don't know what the total addressable market is, but that's going to be amazing. And it's going to make it so you really want to own those two stocks. You
just said something that was really interesting to me, backing up to tech once more. The FANG stocks the FANG companies can't really buy any other companies right now because of the government, as you said. But would M&A activity at this time, when smaller companies could be laying off people, could be preparing for bankruptcy, would it help to allow the FANG companies to buy smaller companies?
Well, I mean, I don't think these are banks. I think there's a lot of companies that don't need to be protected. I think that by the way, I do think the airlines, don't be mad at me about this. I think the airlines need to be protected. We don't want fewer airlines. We like the competition. But I just think that a lot of companies aren't needed. Catherine, a lot of companies came public in the last 2 years. And you'll see the research. I get a run from Ben Stoto every morning, different research. We're hitting up research. And I cannot believe how many companies were created that we don't need. We don't need the 50th restaurant. We don't need the 40th retailer. We don't need the 30th mid-continent pipeline company. We don't need the 60th REIT. They all got jammed through. And I just cannot believe how much crap there is that they brought public during this era when I kind of didn't keep track of how many crummy companies they brought public. But those are the ones that are weak. And those are the ones that have they've played a role in terms of being able to put people to work. And it's one of the reasons why we had such low unemployment those days. But wow, I mean, there's a lot of companies that go under, and they will not be missed.
Jim, if you had to use one word to describe today's current market action, what would that word be?
Let me check. I would say, I've got a word, exhausted. I think it's exhausted. It's a dangerous word.
Exhausted because of the market rally that's going on, and when we're looking at data that could, right now better than expected, but could be worse going 7 to 10 days from now.
It is when that last 2% yesterday was so phony. I mean, I called it a panic rally. It was panic, and just like when you see panic on the way down, Catherine, panic on the way up is no good either. And there's always these people, and I've had to revert to Jimmy Chill. There are always these people who say, Jim, when it goes up, you like it, that fast stuff. But when it goes down, that's when you can complain. And I'd say that on average, I complain more about it going up than I complain going down, because what that does is suck people in. And I think that there's a lot of people who don't understand. I don't like programs. I don't like the emphasis on the S&P. I don't like S&P buying. I like real buying of real companies. This is not a new position. I adopted this position in 1985 when most of the people who criticized me were in diapers, and except for the ones that weren't born. And I think that they have to recognize that when you have a rally like yesterday and it moves everything up, that's simply because they're in the index. And if they weren't in the index, it wouldn't go up. That's the way you have to look at it. Would that go up if it weren't in the index? And the answer is probably not. Or J&G. Well, I want to save stuff for the paid people. But I said, look, there are going to be some stocks. I'm seeing if we got list if we got to fill. There are going to be some stocks, absolutely going to be some stocks that have just going to go up too much because of the programs, and we've got to sell it. And there you go. We sold some.
All right, Jim. Now, before we head over to Action Alerts Plus, I do have a member question or a viewer question for you. It's from Ben Cross, who asks, how can banks account for write-downs, loan loss provisions, credit valuation adjustments in both trading and lending platforms if they do not know how and at what level the federal bailout package will backstop them?
Ben's always right. He's from Cheltenham High, Pennsylvania. We don't know, and one of the reasons why I hate that group is that the write-downs may mean that their dividends go, and that's what Janet Yellen implied yesterday. I thought it was reckless that she did it, but now I decided, you know what? Maybe it's more that she knows something. So yeah, it's really, really, really important, and I don't know the answer. And Ben's right; it's a big question. It's rhetorical, but we don't know.
All right, Jim, thank you for taking the time to join us today, guys. Thanks for watching. We are now heading over to our Action Alerts Plus Daily Rundown show over on actionalertsplus.com. And of course, as always, please keep on sending in your questions by Catherine Ross and at TheStreet on Twitter. I'm Catherine Ross, and I will see you tomorrow.